Good afternoon all, and welcome to the annual Banking and Payments Federation Ireland Economist Webinar, which takes place as part of the European Money Week. I am Ali Ur, Chief Economist with the Federation, and today I'm joined by two guest speakers, Dr. Loretta O'Sullivan from Bank of Ireland and John Fye from AIB. We'll first go with Loretta, and Loretta will cover at her presentation the Irish economic developments, and then that will be followed by John Fye's presentation in relation to some of the global economic developments, and as well as that he will have a special section in relation to Irish housing market. We are joined today by students by over 40 schools across the country, so I hope that you'll enjoy the sessions. And we have a chat function that you can use during the presentation so that you can send in your questions, because at the end of the presentations we'll have a panel discussion. So please send your questions. And as part of the European Money Week, there is going to be a money quiz as well that's organized domestically, and which there will be a final at the European level. So if you can follow our social media channels, you'll be made aware of the developments in relation to how to get or participate in the money quiz as well. So without ado, I would like to introduce Dr. Loretta O'Sullivan, Group Chief Economist with Bank of Ireland.
Hi guys, and it's great to be able to join everybody again. Last year obviously we had COVID, so it's been a while since we've chatted. And what I'm going to do today is talk a little bit about the Irish economy and just bring you up to date on what's been happening. So if we flick to the next slide. And you know, when you're learning your economics, it's all about output and how consumption and investment, government exports and imports feed into that. So when we do this from a practical level, when we talk about output, what we look at is GDP. So on the slide there that you should be able to see, you see on the left-hand side, two blue bars, and that's GDP in 2020 and 2021. You can see this is reflective of the economy growing in both years, which is impressive for 2020 because this, of course, was the year of COVID when everything was upended. All our lives, commercial activity, and the way we go about how we work, how we play, and everything was upended. So the economy still grew, and that largely was due to the fact that we have a concentration in two of the sectors that really benefited, I'd say, in inverted commas, from COVID, and that was pharma chemicals and also ICT. So it was around the pharma piece and it was around the tech piece. Really important drivers. The concentration of those sectors in the Irish economy meant that the economy grew in 2020, and you see that in the second set of graphs there, the lime bars there, that's showing you what was happening in the multinational sector. Very strong growth in 2020, whereas the mint bar is showing you what happened in the domestic economy. So you remember during 2020, big parts of the economy shut down, hospitality, travel, all closed. So that really took a toll. When we go into this year in GDP terms, last year, 2021 in GDP terms, the second blue bar there, you see the economy grew by about 13.5%. So again, very impressive growth. So we're recovering, coming out of that COVID situation. More of the economy began to open up, particularly in the second half of the year. And you see then on the second set of bars, the mint one is up now. So this is the more domestic orientated sectors. So that's growing in 2021 along with the multinational sector. So the combination of the two now, they're both at play. So both parts of the economy growing. And if we move on to the next slide. Always when we think about output and growth, it's important, but it's important for a reason, because it helps create jobs, because it helps improve living standards. So the graph that you're looking at here is unemployment. You can see the mint line again. This one is showing you the COVID-adjusted unemployment rate. So the CSO, the Statistical Office, obviously had a big job when all this COVID piece hit in trying to track and keep track of what was going on. So one of the measures that they looked at was unemployment, and they reflected the fact that a lot of people were receiving the pandemic unemployment payment. So they baked that into the numbers, and you get this mint line, which is showing you the COVID-adjusted unemployment rate. And you can see if you look at that we had unemployment jumping up massively at the start of the pandemic, so up to over 30%. It's come down substantially since. The restrictions have now been lifted, economy is reopening again, and we're way down now. And we do expect that over the next couple of years, unemployment will continue to improve, and we're going to get back to a level pretty much where we were at the outset of the pandemic, so around the 5% mark or so, which is a very low rate of unemployment. If we move on to the next slide, when economists are looking at what's happening in the economy, so we look at things like GDP, which is an important indicator, but it tends to be a lagged variable. It only comes out a couple of weeks, a couple of months after things have happened. So for example, last Friday, we would have got the quarterly data for the last quarter of 2021, but we're now into March. So it comes after a period of time. So we try to keep track then of what's going on at points in time by looking at what we call high frequency indicators. This is survey data, and an example of that is on the screen there now. This is just a measure of economic sentiment, where this is a Bank of Ireland measure where we track how consumers and how businesses feel each month through a set of surveys, and we ask them questions about the economy. Do they think things are getting better? Do they think things are getting worse? We ask them firms about their business activity. Is it getting better? Is it getting worse? We ask about jobs. We ask about house price expectations and so on, and we pull it together into a high level indicator. So this just gives us a feel for what's going on at a point in time, and it's quick. It comes out every month. The very top line there is an aggregation of what, the blue line there I should say, so the middle one, is an aggregation of what consumers and businesses feel. And you can see over the course of the pandemic how the mood has ebbed and flowed. So when we had the crisis, when it hit and everything was shut down back in April of 2020, big dip in sentiment. As things began to reopen or restrictions were eased, you got an improvement. Then if they were pulled back, you got a disimprovement, and so on. But since around the middle of last year, you can see that the line now is at a much higher level than it was, and it is generally improving. And as we've gone into 2022, we're starting to see that improvement tick up, particularly on the part of businesses. So around 55% of the firms now we survey are saying they think that over the near term things are going to get better for them. And that makes sense because the economy is now reopened, the restrictions have been lifted, so they expect people are going to be going out and spending, businesses are going to be investing and needing their products and services. So they're quite optimistic. Consumers, which is the green line, they're a little bit more cautious. So we'll have a look a little bit more at consumers and see what's going on there. So if we flip on to the next slide. And this one is showing you consumer spending over the last number of years, over the course of 2020, 21, and some of the latest data for 2022. And as I was saying there about sentiment ebbing and flow as restrictions were relaxed and tightened, it's the same for consumer spending. So back in 2020, when things were locked down, and as normally happens in a downturn, when things go south, consumers generally tend to pull back on their spending. And this happened this time too. This downturn, of course, was no ordinary downturn. It was quite different. It was imposed to an extent. So some of the pullback in spending reflected the fact that people were worried. They were worried about jobs. They were worried about their finances. So they pulled back on their spending and they increased their savings. And that's what you know from your own textbooks is what we call precautionary savings. For others, though, it was a case that they couldn't spend. And part of the reason they couldn't spend was because opportunities to spend were curtailed. So you couldn't go to the pub, you couldn't go to a restaurant, you couldn't travel. So those opportunities for social consumption in particular were curtailed, meaning then that there was an element of savings that were accumulated because people couldn't spend it. So we have this excess savings piece as well. As the restrictions were lifted as we went through parts of 2020 and again through parts of 2021, you see these big jumps in spending. So all that pent-up demand, that deferred spending got unleashed, and people went out, went to the shops again, went to restaurants and pubs when they could, and so on. So there's been a lot of up and down with consumer spending over the last period of time, but in the round, consumers are now spending again. They are a little cautious though, as I said, and we can see that from the sentiment data. And if we flick to the next slide, part of the reason for that cautiousness and anxiety more recently is around the cost of living. So this is something that's been really well covered in the media and the news, so I'm sure it's something you've heard. This is around inflation and the fact that it has risen quite significantly, and the graphs here are showing you that. The top line is the headline inflation index, headline inflation graph. So this is the basket of goods and services that people buy on a regular basis, and this gets tracked, and we can see that prices have gone up. A big part of that increase has been to do with energy costs, and that's what the green line is about. Around energy costs contributing around 2 percentage points to the inflation rate most recently. So it's running about 5% at the moment, and a good chunk of that then relating to energy costs, which have risen very sharply over the past couple of months. And with the Russia-Ukraine crisis and the escalation of that, there's clearly a risk that we'll see more. We've already seen more move on energy prices, and that we will see more again. So that's something that we're closely watching. So with prices going up, people are just a little bit worried about that. It means a squeeze in their income. They're getting less bang for their buck, and they're concerned. It is worth noting, though, if we flip to the next slide, that when I was talking about that excess savings, this is reflected in the graph here. And this is just showing you that the savings rate, as we went through 2020 and 2021, it's way above normal. So the green line going straight across is the average saving rate we've had over a long period of time, and the blue line showing you how much above that it is. So it has come down because as the economy reopened, people started spending some of that money, but it's still there's still quite a gap, meaning that there's more scope, there's scope for it to come down further. And the fact that households have these savings is going to provide a little bit of comfort to them. Even if prices go up, they have savings there, so it provides a little bit of comfort. Not for all households, of course, because some wouldn't have the same degree of savings as others would have. But it's also the case that the government have stepped in on the energy piece in particular to try and provide some support there. A package of measures has been announced to try and provide some support and help people through this. But clearly there's a pinch and there's a squeeze, and that is just something that is weighing a little bit on consumers at the moment, albeit they are still spending. If we flip to the next slide then, and we move on to the next part of the economy, and we move on to what's happening with investment, the investment side of thing, and have a look at business and government investment in particular. So we're talking there about consumers and the fact that they're being hit with this inflation piece. Businesses at the moment are also facing quite a lot of costs. And what the graph here is showing you is basically the percent of firms who say their costs have gone up in the last 3 months. These are their non-labour input costs. So it's almost 3 in 4 businesses now who are saying that their costs have risen. Number of factors here. Again, it's energy. It's also the case that the pandemic and also Brexit has created a lot of bottlenecks in terms of supply. We've had periods of time where factories have been shut down, so firms haven't been producing things, so there's a backlog of work. We've had Brexit coming on board, which has meant more customs checks. It's meant red tape. So these are adding to costs. There's issues in the supply chains. They've been disrupted. We've got strong demand when economies reopen. So there's a mismatch there, and it's putting pressure on costs. So businesses are facing this, and this is a concern for them at the moment, albeit they are optimistic about the outlook and are looking at the fact that economies are reopening, and that's going to be positive for their business. We flip to the next slide. As well as these non-labour input costs, some firms in some sectors are also experiencing shortages in terms of labour. So this is workers, so they don't have enough workers. And some of this is because migration has turned, so there would have been a lot of migrant workers here when the pandemic hit. Some went home, they haven't returned as of yet. So we have some mismatches on that front as well. And for that reason, when firms are thinking about growing over the next couple of years, they are looking for the government to invest in particular areas, to provide infrastructure in particular areas to support them and to support the growth of their business. And one of the areas that really jumps out where firms are saying they want government to invest, never mind people, is housing. So obviously all of us want houses built because people want to live in houses and have somewhere to call a home. But for firms, it's also important for the reason that they want to be able to attract staff and including workers from abroad, and they want to ensure that they have somewhere affordable to live. This new world that we're in now in the wake of the pandemic, of course, is one where there's a lot more focus on tech. It's really been important during the pandemic, and it will be important going forward as well, particularly with new initiatives like the right to request working from home or remote working. So if people are able to do that, firms are keen then that around the country the telecommunications infrastructure is up to scratch and can support that. So these are areas that firms are concerned about, and also areas that the government are investing in. So you'll have heard during the course of the year as well reference made to the new National Development Plan. So this is a 165 billion infrastructure investment plan on the part of government, which is going to help firms grow and help then the wider communities and society. If we move on to the next slide, it's just making the point that despite the challenges of the last couple of years, it is encouraging to see that 3 and 5 firms are looking to expand over the medium term, so to grow their business. And if we move to the next slide, the reason that they are encouraged and want to grow is because they see the domestic economy improving, so consumer spending, but it's also the case because they see the global environment improving. So many of our firms export, and our main trading partners, the Euro area, the US and the UK, these are all growing now, and the forecasts are for them to continue to grow. So John's going to talk a little bit more about that, so I won't go into it in too much detail, but I do just want to reference the UK situation, and if we move to the next slide. So one of the things that we would have talked to your peers in the past, so a couple of years ago when we were having conversations with students, we would have been talking about Brexit. And of course, Brexit hasn't gone anywhere. It's now happened. We're in a post-Brexit environment, and we're going to feel the fallout of that for quite a period of time. Part of it has become entangled with the COVID effects, so it's difficult sometimes to get at the data and see what's going on. But what data we have, we can see that Brexit has brought about some changes in the relationship, the trading relationship between Ireland and the UK. And we expected it to, and we now see it in the data. So the first block of the graph there looks at the exports that Ireland does to the UK and what we import from the UK. And you can see while our exports to the UK remain very strong, and some of that is to do with the fact that the UK hasn't yet introduced some of the Brexit customs checks. They're due to come in later this year when the negotiations on the Northern Ireland Protocol conclude. So for the moment, exporters haven't really been hit, and that's a headwind and something we'll be paying attention to. On the other hand, the EU has imposed the checks. So goods coming from the UK into Ireland, coming from GB into Ireland, I should say, have been hit. And those customs checks, compliance documents, all add to red tape, all are adding to business costs. And we see that there's been a significant reduction in imports from Great Britain into Ireland. So Irish firms now are looking wider, and they're looking abroad to source some of their products. They're also looking domestically to source some of their products and have reduced reliance on Great Britain. The second part of the graph there is showing you trade with Northern Ireland, so the All Ireland economy piece. And here you can see imports and exports from Ireland to Northern Ireland, they have significantly increased as a result of these changes. So again, this is an area to watch as we go forward. When there's any big change in the structures of economies, in how trade is done, it does have knock-on implications, and that's what we're seeing there. So we'll move on to the next slide. And what we've talked about now is the different components of the economy. So we've talked about consumers, we've talked about our businesses, our government, exporters, and all of that we expect, they're all growing, and we expect them to continue to grow as we go through 2022. So we are looking at the Irish economy growing again in 2022, but always when we do our numbers, we have to be cognizant of the risks. So we put out a set of numbers, but we look to see, could this number go up, could it go down, and what might drive it up or down. So we have set some of the risks out on the slide in front of you there. If we look at the things that are to the upside, so the things that mean we could have a higher GDP number this year, one of the reasons is because of pent-up demand, all these savings that people have accumulated, and now they have an opportunity to release that and spend some of that. So people could go mad. If they go mad, they push up consumption more, and it would push up GDP. We have another set of risks around multinational activity, so to the upside and to the downside. So we talked at the very beginning how we had this concentration in pharmachem and in ICT, and that they've really done well during COVID. And we could see them continuing to do well and continuing to outperform. It's also the case that we have to be very aware that there has been a lot of changes on the global tax front as well. They're due to come in over the coming years. We'll have a higher corporation tax, for example, and that just may impact on Ireland's attractiveness for FDI. So something that could push growth down a little bit. Obviously, given the developments over the last the year or so, COVID-19 setbacks are something that we're very aware of. We've just come through the Omicron variant of the virus. We may have more variants of the virus. Now, there's a lot of vaccination being done now, boosters and so on, so we're better positioned, but it is something we have to be cognizant of. And the other big one at the moment is, of course, geopolitics and the situation in Russia and the Ukraine, where we have seen a huge humanitarian crisis in the past couple of weeks, and what it means in terms of economic developments. Still evolving, situation still fluid. We've seen energy prices rise significantly, and obviously that would have an impact for inflation, so feeding through then to consumers and potentially impacting their spending. And there may be an impact for the global economy as well, which for the Irish economy, because we are an exporting nation, would have an indirect effect for us. So this is a fluid developing situation, something that myself, John, and others will be keeping an eye on and working into our numbers as we go through the next couple of weeks and months. So I'm going to stop there and hand over to John, who's going to talk a little bit more about the global economy and housing. Thank you.
So what I was saying at the outset there was Loretta very helpfully gave a great insight in terms of what's happening in the Irish economy. So what I'm going to do is talk around the global economy and also related to a key topic that you study in economics around monetary policy. So the table here on the first slide details both historic and forecast data, and it comes from the IMF, the International Monetary Fund, and it's one of the key international forecasting agencies out there. And just to focus on one thing, if you look at 2020, you can clearly see the impact that the COVID pandemic and the restrictions had on global growth. We had negative growth of -3%. In the US, growth declined by around 3.5%. Eurozone, it was closer to 6%. And in the UK, it was closer to 9%. So that very clearly shows the experience internationally from the pandemic. And then you can see as we moved into 2021, the sharp rebound in activity. And the underpinning of that was obviously the very successful vaccine rollout. And that triggered a strong release of pent-up demand that had been building over 2020. Loretta spoke earlier around, people wanted to spend money, but because of the restrictions in place, it wasn't possible to do that. So that was an experience shared across many of the advanced economies. You can see then though, when we look to this year, 2022, growth is expected to slow from the levels we saw last year, but still remain very healthy. And the reason for the slower growth this year is 2020 to 2021, you had a downturn and then a sharp rebound. So you're always going to get a situation after a rebound of that extent is slower growth. But there's two key drivers of it as well. From a policy perspective, policy will now be less supportive. So what do I mean when I talk about policy? I mean both fiscal and monetary policy. And then the second key thing that's going to slow growth this year is inflation. And you will have studied how inflation works in terms of definitions, but how inflation impacts growth is your real incomes. So when you take account of the money you earn and take off the level of inflation from that, you have a much slower or lower rate of growth in your incomes. And then that impacts your purchasing power. So what you could buy a year ago for €10, you now can no longer buy to the same extent for €10. So those two things combined overall are going to impact growth this year. And then as we move into 2023, growth will slow again, but still in the region of 2 to 3%. I suppose the big theme for markets this year and the big uncertainty has been just the spiraling surge in inflation. So we've seen a sharp rise in inflation right across all the major advanced economies. And Loretta already spoke in terms of the Irish context around that. But the key driver globally has been that energy price surge in terms of price of oil and gas. And then more recently, the war in Ukraine, where Russia's invasion of the country has saw a spike higher again in commodity prices. So that's led to further upward pressure on inflation levels. So then if we put that in the context of monetary policy and look at it from a perspective of, what's the aim of monetary policy? What are the tools and types? So first of all, what's the objective of monetary policy? The objective is to keep prices stable. And the reason central banks want to do that is in terms of inflation, you want to make sure it's low, stable and predictable, both from a consumer and business perspective. You don't want a situation where prices jump around in any given month, because it's very hard for businesses to price contracts, to operate, but then also from a consumer perspective, if they keep thinking prices are going to fall in a deflationary environment, they'll hold off purchasing. And then if prices keep rising, they become unaffordable for them. So, that's the main objective of central banks in terms of their monetary policy, is to have a stable inflationary environment. And there's broadly three key tools that central banks are using at the moment in terms of monetary policy. The first one is interest rates. So central banks can move interest rates either upwards or downwards. They move them upwards when economies are going well, and downwards when the economy needs some stimulus. And a new tool which is in place in the last 10 years is what's known as quantitative easing. And if you'd have been studying economics a number of years ago, this probably wouldn't have even been in the textbook. So it's a relatively new tool by central banks. And what this is, the purchase of assets, and it's usually bonds, and it's another way for the central bank to put stimulus, to put money into the real economy. And the third aspect, which is relatively new as well, is around forward guidance. And this is where the central banks gives an indication of the future direction of monetary policy. So the types of monetary policy can be summarized into two categories: expansionary or contractionary. So expansionary is where they cut interest rates, they purchase assets, which is quantitative easing, and they tell the market from a forward guidance perspective the policy will become more accommodative. In other words, for example, expect more rate cuts. A contractionary monetary policy would be where they increase interest rates, they sell assets, which is the opposite of quantitative easing, so it's known as quantitative tightening. And from a forward guidance perspective, they tell the market that rates may go higher or will go higher or start to increase interest rates. So they're the broad objectives. Just to focus on one of them in particular, in terms of QE, quantitative easing, how does it help the economy? So the objective of QE is to boost both growth and inflation in a number of ways. So first of all, introducing more stimulus through QE helps to lower interest rates in the market. It leads to a loosening of monetary conditions. It also helps to weaken the exchange rate, and if a country or region's exchange rate weakens, it helps them sell their goods and services abroad, as well as raising import prices. Because for a lot of the time, up to recently, a big issue for central banks was that inflation was well below their target, which is in and around 2%. Quantitative easing also boosts asset prices in terms of value of bonds, equity and property. So it has a positive wealth effect in the economy. People's wealth goes up and then they tend to spend more. It can also allow for easier fiscal policy because if they're purchasing bonds, what tends to happen is the yield on bonds, and the yield on bond on a sovereign bond is basically the interest rate a government has to pay to borrow money. So if central banks are in there purchasing those bonds, the yield tends to fall, so it can allow governments to borrow at much lower rates on markets. And another aspect to it is it just increases the overall money supply and then funds available for lending. And generally speaking too, when consumers and businesses see a central bank being very proactive, introducing stimulus into the economy during the course of a downturn, it tends to boost consumer and business confidence, because people can see that central banks are doing all they can to help the economy during different stages of a downturn. So what we saw during COVID was all the major central banks either cut interest rates and or introduce comprehensive quantitative easing programs to deal with the recession that came as a result of the pandemic. So if we look then back to the real world and inflation, and I already spoke in the context of what's happening in Irish inflation rates, you can see there on those top two charts, inflation in the US and also in the Eurozone is surging upwards. And the key thing is, from a central bank perspective, is both central banks, in terms of the US, the Federal Reserve, or the Eurozone, the ECB, their target is to get inflation in around 2%. So you can see the big difference in terms of where actual inflation is and where they'd like it to be. And you can also see the difference there when you look at the Eurozone chart in the top right corner. Headline inflation includes energy costs. Energy costs are very volatile. At the moment, energy costs have surged, like oil prices are up over 60% since the start of the year. Core inflation is higher as well, it's above target, but core inflation strips out that energy component, so it hasn't risen to the same extent as headline inflation. But I suppose the key thing is that if you look what's happening in the price of oil at the moment, and this is recently on the back of the escalation of the war in Ukraine, oil prices have surged significantly higher. They're gone above $100 a barrel. So two charts there. Brent oil is the one that's used as the European key oil price, and West Texas oil is the one that's used from a US economy perspective. So those surge in oil prices tell you that inflation, and especially headline inflation, is going to continue to move higher. And that's led to a big turnaround in terms of what the market expects from the perspective of interest rates. So the right-hand chart there looks at actual market expectations for interest rates, and you can actually trade this in the market on a daily, hourly basis. There's contracts there based off what the market thinks interest rates are going to be. And the blue line there is basically a year ago, the start of 2021, where the market thought interest rates were going to be over the next 2 to 3 years. So you can see a very flat blue line. The red line is more up to date as of the end of February, where the market thinks Eurozone rates are going to be. And you can see that rate, that line has shifted outwards and upwards. In other words, the market now thinks, as opposed to a year ago, that over the next 2 to 3 years, we're going to start to get a number of rate hikes from the European Central Bank. So it's a big change in terms of the outlook for monetary policy on the back of the surge higher in inflation. So that's the global economy and a monetary policy aspect to it. If we turn now to the housing market, and the housing market also allows us to kind of use some key fundamental tools from economics, specifically around supply and demand and the impact they have. So when we look at the Irish housing market and we look at prices, during what was known as the Great Recession, or the big downturn in the Irish economy, house prices fell by 55% over the period 2017 to 2013. Since then, you can see in terms of the red line, which is year-on-year increase, so it's prices in any given month compared to the same month last year. And the blue bars are just the month-on-month increase, so the change in prices from one month to the next. You can see there, though, that we've seen consistent, strong growth in prices over the last couple of years. In 2019 to 2020, prices were relatively stable, but surprisingly, during the downturn, we did start to see upward pressure come back on prices. And in percentage terms, at the end of last year, prices were 14% higher in December 2021 compared to December 2020. And there's a number of things at play there. But really the key thing that's driving that upward pressure on house prices is the lack of supply versus where demand is. So it's very much an underlying fundamental shortfall in supply that's impacting the housing market and that's driving those prices higher. So if we look at that in a little bit more detail, but first I suppose one key thing to understand is that what's happening in Ireland is not unique here in terms of Irish house prices and the upward move in them. So the first chart there just looks at the level of house prices in the OECD. So the OECD is roughly a grouping of around 40 countries, and you can see there since the pandemic, prices across the OECD have risen in year-on-year terms by around 8%. And also then if you look at it specifically in the European context, which is the chart on the right, and if you look at where Ireland sits in terms of its price rises, right across Europe prices have been on a sustained upward pressure, although Ireland is at the upper end of its European peers in terms of the rate of increase in house prices. But I mentioned that the key thing around prices and the key driver is supply. And broadly speaking, the key issue is that we need to build at a minimum 30,000 units per annum. Now on a year-to-year basis, it can vary, but generally speaking, over the next number of years, the Irish economy needs to build 30,000 units per annum at a minimum. You can see over the last number of years, in terms of the purple line there, which is completions, in other words, that's new supply, has fallen well below that level. We also look at commencement notices, because commencement notices are housing starts, so they act as a lead indicator in terms of what to expect from future supply. And you know, the pandemic saw the expected upward increase in supply over that 2-year period become, you know, stabilise around 21,000 units per annum. We are starting to see positive numbers in terms of new supply coming on stream, but what COVID and the pandemic has done to the housing market, it's roughly delayed the timing before the market gets into equilibrium. So you will have learned in your economics classes the situation of equilibrium where supply and demand become closely aligned. So we are still a number of years out before an Irish economy perspective we start to build 30,000 units per annum. So that's the supply aspect. I suppose just to finish up then around, you know, well, what does the future property market look like? In maybe 5 to 6 years, some of you will be entering the property market looking to rent or looking to buy. And what we have seen is that the pandemic has had a structural change on the property market generally. We've seen a permanent shift to remote working, and now I suppose the buzzword is hybrid. It's a mix between home and office-based working. So what does that impact have on the housing market? Well, from a housing perspective, the impact is increased demand for larger and more rural residential properties. So you no longer have to live in city centre locations or close to the office if you're only going to be in office maybe 1 or 2 days a week. And then the other key aspect from a property market perspective is on commercial real estate. So commercial real estate is offices, retail units, but also industrial units. And from an office perspective, we're likely to see reduced demand for offices and a redesign of office interiors because less people will be in the office on a day-to-day basis. But also from a retail perspective, there's less footfall in city centres now because the same level of people pre the pandemic are not in city centres or town centres as they were before the pandemic hit because more people are working from home. So less commuter travel does impact city centre amenities because there's less footfall in the city centre. But then also from a general perspective over the types of homes being built in the future, the key issue for the housing market is the lack of supply. So, you know, there is developments, and obviously the government Housing for All strategy puts the focus on increasing housing supply over the next 9 to 10 years as a key policy objective for this government or any future governments. But one aspect of that which may change is new designs and materials being used to try and allow quicker build of houses to try and meet that issue around supply. But as I said, when you look at the housing market, you know, your economic tools around supply and demand are very clear and allow to give a clear analysis that the fundamental issue with the housing market is a lack of supply and hence why we see continued upward pressure on prices. Over to you, Ali.
So we have time for some questions. And I'd like to perhaps ask John, following from the presentation, the part on housing. You were hopeful about the housing supply increasing with the commencements and the completions, obviously, in the next couple of years. But we also see some pressure due to inflationary pressures on raw materials, etc., used as input to housing. Do you see sort of cost inflation there, and how do you see it? Because if supply increases, we should see prices coming down a little bit, whereas the cost input factor is increasing. That will probably put up the pressure on the prices. How do you see these two developing?
Thanks for the easy question, Ali. Yeah, so as you say, I suppose, first of all, back to first principles. The key issue for the housing market is the lack of supply. So the only way you're going to get a sustained improvement in the price dynamics in terms of to lower that continued acceleration in prices is to improve supply. Then when you talk to developers will tell you that because of what you mentioned there around increase in cost pressures, they do need some level of increase in prices for it to be feasible to start new projects. So that has been the issue, because during the downturn you had a 55% peak to trough fall in house prices, but back then builders would have told you didn't have a 55% fall in building costs. So that was a key issue. So in terms of that kind of challenge between increase in supply and those cost pressures, one big issue for the housing market too, and developers will tell you, to get 30,000 units per annum, you need more workers. But an issue at the moment is labour shortages generally in the economy. So I think in terms of the outlook, a key thing is that we need more workers in the construction sector to develop those 30,000 units. There will still be, house prices will still increase. It's going to be a number of years before we build 30,000 units per annum, and even then you have the pent-up demand. So it's going to be probably late into this decade before you can say the housing market will be in equilibrium. So that will still see upward pressure on prices, as will the cost side. But the key thing is we need to build more houses and more apartments in locations where people want to live.
Thank you, John. And Loretta, I think some of your research in relation to the survey results, especially the increase in the non-labor costs, and I think construction, nearly 80% of the respondents, if I remember correctly from your chart, they reported that the costs have increased, non-labor costs have increased over the past 3 years. So that's probably putting a big pressure.
Absolutely, for construction, definitely the non-labour cost piece has been important, and some of that has been around COVID and Brexit supply bottlenecks, that things have gotten bogged down and there's more red tape, so the costs have gone up. It's also the case that for the construction sector in particular, it is suffering from a shortage of workers, and a key piece for that will be around a return to migration and workers coming back in again. And as I said, we saw a big turn in that story over the course of the pandemic, so we will want to see people coming in from abroad again, and generally more participation and people getting involved in the labour force and helping to solve those problems.
Thank you. Maybe just a last question in relation to some of the global developments on the monetary policy and inflation, because I think it'll be relevant for this generation. They're probably seeing the highest inflation rates ever, probably since the 1980s. I mean, there's a general debate around whether the inflation was transitionary or whether it was persistent. There's still no conclusion there yet, but if it is mainly driven by the energy input, obviously we have the excess demand coming from the pandemic savings, but that excess demand is probably going to stabilize soon. If it is still driven with further political events, due to energy input prices going up, do you think increasing interest rates will help in that regard? Because that's the way to help combat inflation.
Yeah, so it's a tricky balancing act for central bank. I suppose you can definitely say it's a longer transitory, given that transitory, probably the definition was 6 to 9 months, and we're nearly 18 months into it. So central banks at the moment, and the ECB is meeting this week, and next week we have the Bank of England and the Federal Reserve in terms of their interest rate setting policy. So they have a tricky balancing act. They still see the need, especially in terms of the US central bank and the UK central bank, the need to increase interest rates. Inflation is much higher in both of those economies, but at the same time they don't increase interest rates too far that they choke off growth in the economy. So they're likely to be more cautious than they were before the escalation of the conflict in Ukraine around the extent of interest rates. And we've seen that the market has pulled back some of its expectations around how much interest rates we're going to get from those central banks over the next 2 years.
Yeah, I suppose we're just in a period now of trade-offs, so where we have to look at things from both sides. So there's the inflation angle and there's a growth angle, and that is the balance that policymakers, be they in fiscal institutions, monetary institutes, that's what they're looking at the moment.
Thank you very much, and thank you for the excellent two presentations. I think they gave a good overview of as to what hopefully you cover in your textbooks from components of the parts of the economy as to what's happening in the different parts of the economy. We touched a lot on interaction between supply and demand, and obviously the price dynamics. So hopefully that gave you a good understanding as to how these dynamics work in the real economy. I'd like to thank you all for joining us today again, and hopefully we'll be able to have some sort of a physical event next year. And as I mentioned before, don't forget to follow our Twitter account, BPFI News, for the developments in relation to the quiz, which may lead your team to go to the European finals representing Ireland. Thank you very much.